And we're back with another episode of Living in Granbury and Beyond. We really appreciate you tuning in to today's episode. There's been a lot going on, so today we wanted to give kind of a brief snapshot with current news in terms of mortgage rates, the housing market, what's going on in the economy, to kind of give a updated look at the year ahead. So before we jump into that, if this is your first time to the channel, we really appreciate you tuning into today's episode. Be sure you stay tuned to the end. We're going to update you on a couple of developments that are going in Granbury, some new businesses, and it's kind of an infrastructure update. So stay tuned to the end. We're going to update a few businesses that are coming in. If you have any questions, if you're thinking about relocating here, if you're on the fence, maybe you're going to be retiring and trying to determine the timelines, maybe you live here and you're thinking about selling. So if for any reason you have any questions, give us a call, shoot us a text, send us an email. We'd love the chance to connect with you and give you any advice that we can. Okay, so jumping into today's episode, we are going to be focused on the real estate market. And the thing we're going to be looking at specifically is, first, the mortgage rates. So some news is out this week that current mortgage rates dropped below 6%. And this is like the first time in 3 years that we've seen this particular mortgage rate average below 6%. So we've hit a fresh new low in terms of mortgage rates, and that has caused a sharp increase in home sales over the last 30 to 60 days. I can show you another article here to give you some context. So new home sales have surged here in the last couple of months, and a lot of that is on the backs of this lower for longer mortgage rates, getting down to 6%, even going under 6% for a little while and staying there for 30, 60, 90 days has really helped tremendously in terms of getting the market moving again and getting through some of that stagnation. We have another thing that came out. The president has been pretty committed to trying to lower the mortgage rates. There's been a lot of talks about a lot of things, including 50-year mortgages and all this and that. Well, last week, or this week actually, last week when you see the video, this week for me, there was a $200 billion order of buying back securities. So you go in and look at this. Purchase of mortgage bonds here had a tremendous impact on lowering the rates. How long will that last? That's to be determined. I don't think that's going to be a long-term solution unless they keep buying these mortgage bonds every month, but we'll see. I think the real key here is that the leadership of the country is trying to lower the rates to make housing more affordable. That becomes, I believe, the key that is going to drive the rates lower throughout the rest of the year in 2026. Now, with that, there's also some challenging things that's coming out. The PPI report and inflation report came out, and both came in higher than anticipated. What that does is it creates tension. We want to lower the interest rates. We want to improve the affordability of the housing market, but to do so will require us to exacerbate our issue with the inflation. So now the inflation is starting to ease up. As these pressures are coming down on the housing, now inflation is starting to come back up. I mean, it's almost immediate. So we don't have much relief. So the Fed is going to have to play a real tight balancing act to be able to pull this off. I know the president is mainly focused on housing, but inflation is a real problem and a real concern. So it's going to be a tough thing, honestly. Another piece of information we've got here, just so you can see it, is stocks are at record high, U.S. debt is at record high, deficit spending is at record high, platinum's at record high, copper's at record high, silver's at record high. Man, this is tough. So inflation is a problem, and fiat currency is having inflationary issues. A lot of people are investing, in hard stuff like gold, silver, copper, and things of that nature. So it's really going to be a difficult market to try to navigate. So that's the situation we're in. And the Fed and the president and everyone's having to try to come up with a plan that's not going to cause inflation to roar back as it did in 2022, But at the same time, housing affordability is terrible right now, and we need to get some relief in terms of affordability. One more that we want to look at, there was some news that came out last week that Trump was not going to allow these institutional investors to go in and buy single-family homes. The impact of that, it was very much overestimated and exaggerated. Institutional investors only buy a very small, like 1% of homes. Now, what they do is they will take homes, single family homes, and they'll replace it with the keyword rentals. Now, of all the homes on the market, what's the percentage of them that are rentals? It's actually lower. So, of that subset, that small subset of total homes, there is a large number of institutional investors. So, they may make up 25% of the rentals, but that's still only 1% of total home sales. So the impact, I believe, was very much over exaggerated. I'm not saying I'm for or against it. I haven't done much in terms of an evaluation on it. I know there are concerns when people from other countries or corporations that have a lot of foreign corporations. So all in all, I believe that the impact of getting rid of institutional investors for single family homes is going to be negligible. It's not going to have much impact on the housing market. And then another piece of information that I try to keep up with that I follow is specifically with regard to the job market. I've mentioned labor over inflation. Mortgage rates are going to follow the labor market more than they're going to follow inflation. If the labor market breaks, if we continue to see a softening labor market, we're going to see continued lower rates. If that is the case, these signs show that the labor market is still in a bit of a pickle. There was a job report that came out recently that showed that there were more jobs added, but they've been doing downward revisions every couple of months. So the question is, what is that going to look like in 2 or 3 months from now? Because once they do the revisions, it's actually going to be a lot worse than what we thought, probably. That's been the case for the last 2 years. So with that, the job market is in a situation where it is questionable. It seems like it's continuing to deteriorate or at least maintain a very pessimistic outlook in terms of overall job market. That is news that should keep the interest rates lower for longer, and it should continue to give some breaks on the mortgage rates, which should stimulate some economy in the housing, which will trickle down and benefit the job market eventually. Inflation is a concern. It is something that we are keeping an eye on. The PPI and the CPI report came out, I believe, 0.3% above expectation, which is significant. That is not good news. We do not want to see that. That means that if the Fed were going to go in and take some aggressive moves to try to improve the mortgage rates, now they've got to really tame what they're wanting to do in order to make sure that this inflation is not going to become a major issue again. So that's where we're at in the market. We have a weak job market. We have a growing housing market. We have a warming housing market. Prices are starting to creep up again in the real estate world. And selling this spring looks like it's going to be a good time for it. The market is improving. So as we see all of this taking place, I think that the housing market is benefiting from the overall market right now. And as long as nothing drastically comes in to change it, we should see a pretty good year for real estate coming into 2026. So I hope this was a helpful video, gave you some good information. If you have any questions, want to bounce something off of me, shoot me a text, send me an email, give me a call. We'd love to hear from you and answer some questions. If there's any specific thing you want me to do a video on here in Granbury, any specific questions, shoot them over to me. We'll get them in the hopper and we'll work on them and try to get that out to you. So really appreciate it. Hope you guys have a great new year as we're entering into the new year this year. We had a very hot Christmas here. Hopefully we're going to get at least a little bit of cold weather before we end the winter and we get back into the spring. But we're looking forward to it and hope to see you around Granbury sometime.